Good morning and welcome to the Killik and Co market update. It's been another volatile week for markets triggered by persistent inflation fears. We've learned here in the UK that inflation is currently running at 5.4% per year, and that's a 30-year high. And that's on top of news last week that inflation in the US is running at 7% per year. Most economists now expect that the Bank of England and the Federal Reserve will both put interest rates up 3 times this year, and there are some concerns that that could start to put the brakes on economic growth. On top of all that, we've then got fears that Russia is about to invade Ukraine, and that's due to the fact that there are now 100,000 Russian troops on the Ukrainian border. It's not yet clear whether a Russian invasion of Ukraine would trigger a military response from the West, or whether they would just use economic sanctions. The situation is currently very unclear. It's definitely harming sentiment, and it's clearly one of the reasons why markets have fallen over the last few weeks. Those investors with global equity portfolios would definitely have noticed some portfolio weakness over the last month, and I think there are 2 different reasons for that. One is certainly the weakness that we've seen in markets overall. Let's take a look at this chart here, which shows the MSCI World Index over the last 2 years in percentage terms. If we go back to mid-December, you can see that the index was up 34% on that 2-year basis, but now it's been selling off a bit and it's currently up 27% on that 2-year basis. The other reason for some potential portfolio weakness is currency. Take a look at this chart here, which shows the pound versus the dollar over the last 2 years. You can see that big sell-off in March 2020 when the pandemic first took hold, and that was when investors fled to the safety of the dollar because of fears about the pandemic. But what I'm interested in here is that strength in the pound that we've seen over the last month. The pound has actually strengthened 3% against the dollar in this time period, and that will have negatively impacted portfolios for UK-based investors holding dollar stocks. Two big bits of news relating to acquisitions have hit the headlines this week. Firstly, Microsoft has agreed to buy video gaming company Activision Blizzard for $69 billion. That might sound like a huge amount of money, but bear in mind that Microsoft is currently worth over $2 trillion and it has over $130 billion in cash, so Microsoft shares barely moved when this news was announced. Gaming is currently one of the fastest growing areas of entertainment, and the market is expected to grow at over 13% until at least the year 2028. Microsoft already has quite a good foothold in this market because of its ownership of Xbox, but this acquisition would make it the 3rd biggest player in the world, behind Tencent and Sony. Activision Blizzard owns some of the most popular games in the world, including Call of Duty and Candy Crush. And it's thought that Microsoft wants to become almost a sort of Netflix of the gaming world, where players would pay a monthly subscription and they would then be able to log in on any device and play any game. Microsoft shares have performed incredibly well under current Chief Executive Satya Nadella. Here's the 5-year share price chart. You can see that Microsoft shares have been caught up in the recent market sell-off, but despite that, they're still at almost twice the level they were at pre-COVID. This acquisition seems like a very exciting move for Microsoft, but we'll just have to wait and see if the regulator allows it to go through. The second bit of big acquisition news this week is Unilever's announcement that it had tried and failed to buy GlaxoSmithKline's consumer healthcare business for £50 billion. Unilever is currently worth about £94 billion, so this would have been a massive acquisition for the company, and many shareholders were very vocally opposed to the deal, including Terry Smith, who's the manager of the Smith Fund and a very big shareholder in Unilever. Unilever has really struggled to achieve growth over the last few years, as you can see by this share price chart here. It shows the share price performance in percentage terms of Unilever and 2 of its key competitors, Nestlé and Procter & Gamble. You can see that Unilever shares have only gained 9% over this very long time period, whereas the other 2 companies have achieved share price gains of over 60% each. Many shareholders in Unilever are of the view that the company should be focusing on improving its own operational problems before embarking on any major deals. And as for GlaxoSmithKline, that's another company who has really struggled to achieve growth over the last few years, and again its share price hasn't really gone anywhere over this time period. And many shareholders in Unilever are questioning whether these consumer healthcare assets would do any better if they were owned by Unilever rather than GlaxoSmithKline. Unilever's £50 billion bid was rejected, and the company has said it won't go any higher. But the whole episode has really shone a negative spotlight on Unilever and its current growth problems. Moving on to have a look at next week. It's very busy on the corporate calendar because it's currently corporate reporting season, and we're expecting results out from some of the biggest companies in the world, Microsoft and Apple. That's it from us. Enjoy your weekend, and we'll see you next Friday.